It seems like a bank is a good place to keep your money, but few people know the secrets hidden inside these financial institutions. Billionaire Henry Ford once said, "It's good that people don't understand how the banking system works, because if they did, there would be a revolution." Many people don't know much about money, which is why there is a big gap between the rich and the poor. You can't get rich unless you know how to handle money. Today, I'll share the banking secrets that only rich people know. How do banks make money from you, and what can you do to keep your money safe from greedy bankers? Find out now. Welcome to our channel. Subscribe now if you want to get rich. As far back as the 7th century BC, the city of Babylon had its first bankers who lent money with interest. This was when the first banknotes appeared, worth the same as gold. The word bank comes from the Italian word banco, which means table. At first, banks exchanged large amounts of money for smaller ones, exchanged coins, and handled other cash tasks. As economies grew, banks offered more services. The first private bank in the world was a group of private people from Genoa, united in the partnership of St. George in the 12th century. This bank gave its first big loan to the Genoa Republic for a war in 1148. In return, to pay off the debt, the partnership was allowed to collect some taxes from citizens. By 1407, the Bank of St. George was officially set up with clear rules. Back then, people had mixed feelings about banks. On one hand, they were seen as reliable, but on the other hand, bankers were thought to be greedy or tricky. Money lenders were even banned from communion and a normal Christian burial. Today, people's attitudes towards bankers have not changed much. This distrust is understandable because the banking system still causes suspicion. There's no doubt that even your bank has secrets, and now I will tell you more about them. Banks don't store money. Deposits are often advertised as a safe way to earn passive income. The problem is that in many countries, this doesn't work. The interest rate on deposits is too low to keep up with inflation. For example, in 2020, the top banks in Switzerland offered deposit interest rates of only 0.5% to 1.5%, while the average inflation rate was 1.5% to 2%. This means your income will be eaten up by inflation. Banks often lower interest rates on purpose because they don't benefit from your wealth. However, they do profit by keeping your money. They allow people to open deposits at a low interest rate and then lend this money to others at a higher interest rate, making money from the difference. Governments also benefit from this because they gain some control over citizens' money. This is why the super rich look for ways to protect their wealth. Banks serve themselves. Banks exist mainly to serve themselves, with other customers being secondary. When you deposit money into a bank, it becomes the bank's asset. When you borrow money from the bank, it also remains the bank's asset. This puts the bank in a nearly win-win position, always acting in its own interest. Banks won't fight for the person who keeps money in them. They fight for more interest and control. Once your money is in the bank, it is no longer just your property. It also becomes an asset of the bank. This means the bank can use your money to lend to others and make profits. They lend out your money at higher interest rates than what they give you for your deposit, making money from the difference. A bank's credit limit depends on how many deposits it holds. The more money people deposit, the more money the bank can lend out. However, this ratio is always unfair. Banks can lend out much more money than they actually have in deposits, thanks to the fractional reserve banking system. This system allows banks to keep only a small fraction of deposits on hand and lend out the rest. Banks also benefit from fees and charges. They charge fees for account maintenance, overdrafts, and other services. These fees can add up, making a significant profit for the bank. Additionally, banks invest the money you deposit into various financial instruments to earn more returns. Overall, banks prioritize their profits and stability over the interests of individual customers. While they provide essential services, their primary goal is to maximize their own financial gain. Banks don't give money to people who look poor. Bankers are among the best-dressed professionals and often judge others by their appearance. If a customer doesn't look good, the bank may not want to give them a loan. This is because banks view appearances as a reflection of a person's reliability and financial stability. If a borrower looks like they need the money, they probably won't get it, because banks see them as a higher risk. However, if a borrower looks like they don't need the money at all, they will probably get what they want. Banks prefer lending to people who appear wealthy and stable because they believe these borrowers are more likely to repay their loans. This can create an unfair system where those who need financial help the most are the least likely to get it. The only exception to this rule is if the person has a bank account. In that case, the bank staff can check the account to see if the person is really rich. If the account shows a healthy balance and good financial activity, the bank is more likely to approve the loan. Without an account, the bank will judge customers by their appearance and make quick decisions based on it. This practice can be harmful because it perpetuates inequality. People who need loans to improve their financial situation may be denied simply because they don't look wealthy. On the other hand, those who are already well off have easier access to more financial resources, allowing them to become even richer. Banks' reliance on appearances can also lead to discrimination. People from certain backgrounds or with certain appearances may be unfairly judged and denied financial services. This further widens the gap between the rich and the poor, making it harder for disadvantaged individuals to improve their financial standing. Banks often serve their own interests first and judge potential borrowers by their appearance. This system benefits those who are already wealthy and makes it difficult for those who need financial help to get it. Understanding these practices can help you navigate the banking system more effectively and seek out fairer financial opportunities. Bankers get an annual bonus for loans. Bankers get an annual bonus based on the loans they approve. Only managers responsible for loans receive this bonus, which depends on the number and value of the loans. At the end of the year, bankers are more eager to approve loans to secure their bonus. At the start of the year, there is less pressure, so managers are more cautious. As the year progresses, they feel the need to approve more loans. Rich people take advantage of this by asking for larger loans towards the end of the year, when bankers are more likely to approve them. This helps them get bigger loans due to the bankers' need to meet their targets and earn their bonuses. Banks make money on you. Banks make money off you and your information. They have a valuable list of clients that they use to make new offers and increase profits. Sometimes banks even sell their customer lists to other financial companies or scammers, depending on how honest their employees are. Banks also make money through fees on credit cards. They can offer you a card with a fee or charge a hidden fee just for using your card. When you buy things with a credit card, the seller is supposed to pay a tax, but they often pass this cost on to you by raising prices. This hidden cost is called a shadow tax. Better terms for the rich. Banks prefer lending money to rich people rather than poorer ones because it's less risky. If a rich person can't repay a loan, they can sell part of their business to pay it back. Banks also favor rich clients to ensure they have someone who can lend them money if the bank itself goes bankrupt. Manage your finances wisely. This information doesn't mean you should stop using banks entirely. Instead, think about how you manage your money. For example, instead of making a deposit, consider investing your money or starting a business. Instead of using your credit card, pay in cash when possible to avoid hidden fees. Don't let the system take advantage of you. This is key to getting rich. That's all for today. Subscribe to the main finance channel and start your journey to wealth.